right, so welcome once again to corporate financial management, which is accounting 306. So let me start by listing the topics under the course. So topics. So first we'll look at the sources of finance. Then move on to the valuation of securities. Then business valuation. We can move on to the cost of capital, and the required rate of return. Cost of capital and the required rate of return. Then the capital structure determination. Then dividend policy. So look at measures and acquisition. Then financial risks, managing financial risks. We can also talk about the public financial management, PFM, introduction of the PFM. All right, so today we are starting with the sources of finance. Okay, so before we begin, I would like to ask, what are some of the factors that would determine the source of finance that a business must go in for? What are some of the factors that will inform you that, oh, okay, because of this reason, I have to go in for these sources of finance? What are some of the factors? Or better still, what is the sources of finance itself? How do you understand the sources of finance? When we say sources of finance, what is source of finance? It's the ways and means in which organization would obtain what funds to be able to engage in their operation, their business operation, right? So the sources of funds, where they get their funds to run the organization. All right. So knowing this, can I now ask what would determine the source of finance that you go in for? What would determine the source of finance that? And I believe, you know, when we say the source of finance, we have the short term, and the what? We have the short term and the what? The long term. The long term source of finance, right? And I believe when we say the short term, what are some of the examples We have the bank overdraft. What else? Bank overdraft. What else? Short-term loans. Short-term loans. And then we can also have trade credit. Trade credit. Trade credit, right? And then operating lease. We can also have operating lease, right? That's a short-term lease. So operating lease and many more, right? Then when we talk about the long-term sources of finance, what are some of the long-term sources of finance?
We have equity shares.
Equity shares. Or we can say equity finance, right? Equity finance. What else? And then debt finance, right? Debt finance. Equity and then debt finance, right? Okay, so last semester when we were doing the introductory part or the part one of the financial management, I think we also discussed what that debt factoring. Debt factoring can also be a source of finance. I don't know if you still remember debt factoring, whereby businesses would engage third parties who would take on the receivables. We see the receivables of the business, where the third parties would go in and take their loans, their monies from on behalf of the business, on behalf of the business. I don't know if you still remember. Do you remember that? Where third parties, the business will engage third parties who would collect their debts for them. Right? So they will, instead of going chasing their customers for their debt, they will not do that. They will engage third parties who will do that on their behalf. So this debt factors or factors would give out, let's say your receivable is 80,000. They can give you about 80% of your receivables. So when they give you the 80% of the receivable, they will go in for the 100% from their customers. And then they would, when they get the 100%, they are making a profit on it, right? That's when they make a profit on it. So they will give you the business 80%. They will give you cash of 80%, and then they will go after your customers, your trade receivables, and then they are going to get the receivables or the amount that those customers owe you. So that is also a form of short-term finance, whereby when they give you the 80%, you can use that 80% to finance the operations of that business. So we say debt factors. It's also a form of what short-term finance. So under long-term, it's basically equity and then what, and then the debt finance. Equity and then debt finance. So taking them one by one, I believe we know what overdraft is. Bank overdraft, whereby you are allowed to withdraw more than what you have in your account. Let's say I have some funds with GCB, and then I have like 2,000 Ghana cedis with GCB. But then I need, say, 3,000 Ghana cedis for an emergency, right? So, or to invest in a particular inventory. So you see, I might, or I will inform my bank that, oh, I need, even though I'm having 2,000 cedis in my account, I would like to get 3,000 cedis so that whenever I deposit money, it can be taken out from it, right? So it's a form of short-term loan, and that is also a short-term finance. Then we talk of the trade credit. So what is the trade credit about? So the trade credit is basically whereby maybe you are given a number of days, right? You are given a number of days to pay back your debt. So within that period, within the number of days, you see you have funds with you. So you can invest that money. You are having your creditors' money with you. You can invest that money back into the business, right? So you can invest that money back. So it's like basically purchasing on credit. Purchasing on credit. Let's say you are an entrepreneur, and then a cement company engages you, or you engage a cement company. They should supply you about 500 bags, about 500 bags, or 3,000 bags, so that when you are done selling, you pay them back, as you pay them their money, or maybe you pay them back their money. So you see, when they give you those goods, it's a form of finance. It's a form of short-term finance. You can sell the cement and then get some funds, reinvest the funds into another business, and then make some interest. So the trade credit is also a short-term. Then we have the operating lease. Usually, instead of buying an asset, you can try to lease the asset for maybe a number of period. Instead of buying a long-term asset for your business, you may decide that, oh no, I don't have enough cash, or my resources are not enough. Therefore, you would rather get the assets on an operating lease, which is a short-term lease. So in effect, it's a form of finance to you, the business, and also the debt factor, as I had earlier explained. Then under the long term, you have the equity finance and the debt finance. Equity finance. So what are some of the methods? Let's take the equity finance. Equity finance. So with the equity finance, that's where we all know that equity is about when we issue shares, right? When we issue shares. And I believe you know that it is only quoted companies or public companies that are mandated to issue shares, right? That are mandated to issue shares. So when the company is quoted on the stock exchange, the company, so let us look at some of the methods. What are some of the methods of issuing shares? Methods of issuing shares. What are some of the methods of issuing new shares? So we have some methods of what? Issuing shares. So before you can issue shares, you must be what? Be a listed company or a public company, right? So they can issue shares, one, through the public issue. The public issue. The public what? Issue. So what do you mean by public issue? Whereby we sell to the general public, right? We sell the shares to the general public. We offer the shares to the general public at a fixed price, at a fixed price. And this public would purchase these shares, right, at a fixed price. Yes. So that is the public issue. Then we can also another method of issuing shares is also the public offer for sale by tender. Public offer for sale by tender. Public offer for sale by tender. So what do you mean by public offer for sale by tender? So here This way we sell to the general public. However, the share price is not a fixed one, right? It's not a fixed one. Here is a direct sale to the general public, right? So the general public are invited to bid for the shares. So the one that would bid a higher price would be given the shares. So it's like we have offer by tender. You have given it to the public. Now those ones we are inviting the general public. But then here is how much will you give customer A or shareholder A? How much will you pay? I want to purchase these shares at this price. Yes, I want to purchase this at this price. So you see, the shareholders are giving out their price. They are giving out their price. So that is the tender. Definitely, you know that we will give out the shares to the what? So we will definitely choose the particular share price. The share price that would make all the shares to be bought. I don't know if you get it. The share price that would allow all the shares to be taken away, right? So we choose the minimum one that would allow the shares to be taken by all the respective or potential shareholders. So that is the offer by sale. So these are the methods of issuing shares. You can get this as a theory question. What are the methods of issuing shares? And these are the methods. Okay. Let's move on to the next method. So we have talked about the public issue and then public offer for sale by tender. Now, placing. So with the placing, is like you are giving it out to special people. So usually it is done by investment bank. It is done by investment bank, whereby they arrange for their clients. They give the shares specifically to a particular client to buy it, right? So they give this to a particular client. But the shares is 100%. The investment bank can give out only 75%. So here you are giving the shares to private investors. However, you can only give out 75%. The remaining 25% should be given towards the public, general public. The remaining 25% should be given to the general public. So that is the placing, whereby you are giving the share to specific private investors. However, you cannot give the entire 100% to those private investors, but then you give out 75%. The remaining 25% should be given out to the general public. At least 25%. At least 25% should be given out to the general public. 25% given out to the general public. General public. All right. So now let's move on to the next method for issuing shares. Okay, so we can talk of right issue. Right issue. What is the meaning of right issue? So whereby the existing shareholders are given additional shares, but at a lesser price. So with the right issue, we are not going out. It is an internal form of issuing shares, right? So we are not going out of the entity, but the existing shareholders buy the shares in proportion to their existing shareholdings, right? So this is where the existing shareholders buy the shares in proportion to their existing shareholding, right? So usually it's at a lower price of the actual price of the shares. So let's say the actual price is 5 cedis. Here they are going to purchase it at a lesser price, say maybe 3 cedis, right? So that is the right issue, right issue. So that's where you hear maybe 1 for this, 1 for that. You are getting 1 for 5, 1 for 3, 1 for this. So all these are, that is an example of right issue. The existing shares that you have, you'll be given an additional shares on that, right? So here you pay some money. Unlike the bonus issue, we have something also called bonus issue. That one, with the existing shareholder, you are given an additional one, bonus. Instead of paying you dividend, we would try to pay, give you some shares, right? Instead of paying dividend, we'd rather give you shares. So that is bonus shares. With that one, you don't pay anything. But with the right issue, you buy an additional shares at a lesser rate, at a lesser price of whatever we know already. All right. So it is usually lesser than the market price. So let us look at some of the choices still under the right issue. There are some choices that the shareholder has. Choices of the shareholder when a company announces a right issue. So choices for the shareholder when a company announces, choices for the shareholder when a company announces a right issue. So when you're in a company and the company announces a right issue, what are some of your choices? The options that are available to you. So one, you can either take all the shares or their rights. So here, take up all their rights. To take up their rights. So they can take up their rights and then buy all the new shares. And buy the new shares. So and buy the new shares that have been offered. That have been what? Offered. And buy the new shares that have been offered to them. Or they can renounce their right. Renounce. So let me underline. Take up their right. Renounce their right. Renounce their right. And sell let me use red pen to underline. So they can renounce their right and sell the right. And sell the right in the market. And sell the right in the market. So here, the first one is take up their right. Where they can take up their right because they have the right to do so, right? They have the right to buy additional shares at a lesser price. So they can take up their right and then buy the new shares that have been offered to them. Or they can renounce their right and then sell their right to another investor. They can sell their right to another investor to subscribe for the new shares. Instead of them subscribing it themselves, they can sell their right to another investor so that the investor can rather subscribe to the new shares, right? So usually they sell their right at a price called New paid price. New paid what? Price. New paid price. New paid what? Price. Or they can take parts and then sell parts. So you see there are options available to them. They can what? Take parts. So take some rights. Take some rights and renounce the rest. Right? And renounce the rest. So we can see that this is basically is a combination of the first two, right? It's a combination of the two. And then the last one is they will do nothing. Do nothing. Do nothing. So if they do nothing, what do you think will happen to their share price? If they do nothing, what do you think will happen to their existing shares? Their existing shares will fall. The existing shares will fall after the right issue. Existing shares will fall after the right issue. And if it falls, it means they are going to make a loss. So it means they are going to what? Make a loss. So you see that doing nothing is also a strategy. So sometimes when you are faced with certain circumstances, it is prudent to do nothing, right? So doing nothing is also a form of strategy. It's not everything that you react to. Sometimes when something is happening, you just stay back and watch. Do nothing. It's also a form of strategy. But here, if they do nothing, means their shares would actually what? Fall. Would actually fall, right? Actually what? Fall. Actually fall. All right. So now let's move on to the fifth method. So this is the fifth method will be underwriting of new shares. Underwriting of new shares. So the underwriting of new shares, usually this was some group of investors would come into an agreement that if the shares are not purchased by investors, they are willing to buy up to a certain amount, a maximum quantity, right, of the shares at the issue price, right? So this group of investors will come up with an agreement that if the shares are not purchased by the existing shareholders, they are willing to purchase these shares, but for a commission, right? But for a commission. So that is an underwriting of shares. Underwriting of shares. Then what else? So internally generated funds. Internally, we are talking about equity, right? So internally generated funds can also be equity form of what? Finance. So internally generated finance. That is basically talking about the retained earnings. Retained what? Earnings. So instead of going internally generated what funds. So I believe you know internally generated funds is one of the or the most common source of finance for most companies. Is the one of the common source of finance, internal finance for most companies. Instead of so they will rely on their retained earnings, the profit that they made, they would invest the profit back. They would invest the profit back, right? So that is the equity finance. Equity finance. So now this is the method under equity finance. So how do we choose? How do we know which one will work best for us? So choosing between the sources of finance, choosing between the sources of finance, sources of equity finance to be precise. To the above that we have listed, what would determine our choice? How do we know which one will work best for us? As a small organization, you know, I cannot issue shares to the general public, right? So what do? Then I might rely on the internally generated funds. This is my retained earnings as a form of the equity finance. Instead of issuing shares to the general public, I would rather rely on the internally generated funds. So what are some of the factors that would determine the choices? So we would look at the accessibility of the finance. Are you able to access the funds? So the accessibility of the finance, accessibility of the words of the finance. So you need to, will I be able to get this finance? Is it easy to get? Then the amount of finance, I need huge money. Therefore, my internally generated funds is not enough. And to be prudent, I issue shares to the general public so that I can get a huge sum of money, right? Than depending on my internally generated finance. So there's accessibility of the finance, the amount of finance, the amount of what finance. I want big money, right? I want big funds. I want big funds. Then the cost of issue, the cost of getting that funds. So cost of the issue procedure, cost of the issue procedure. I want big money. I want big money. And the cost of getting that money is very high. So you see, these are the three factors that I would consider, and with respect to choosing between the sources of equity funds, choosing between the equity or funds. Quickly, let's move on to the debt finance. Let's move on to the debt finance. To the debt finance. We've spoken about the equity. We've spoken about the equity. Long-term debt, long-term debt, right? That is the debt finance, long-term debt. I believe you know that the long-term debt is also known as the bonds, long-term debt or the bonds, right? Long-term debt or the bonds. So usually it's in the form of what? Debentures. So you've heard of debentures before? Debentures or loan notes, right? Debentures or loan notes. You've heard of them? So they are the sources of what? Long-term debt, long-term debt, right? So what is the debentures? What is the loan notes or bonds or the debt? So a bond is basically a written acknowledgement. So what is a bond? is a written acknowledgement of a debt, a written acknowledgement of a debt by a company. And it's normally containing provisions. Normally containing provisions as to payment of interest, and the terms of repayment, repayment of the principal, principal, right? So it's an written acknowledgement, right? It's a paper, whereby a company and this paper contains the provisions as to the payment of the interest and the terms of the principal. So if you don't know what a debt is, especially I think on what is an Eurobond, so you would say that you are in level 300 and you don't know what an Eurobond is. So you see that when the former Vice President, Dr. Mahamadou Bawumia, usually maybe we issued an Eurobond. You see, you have gone to school, but you don't know what an Eurobond is. So if issued an Eurobond, your grandmother at a village might be thinking that, oh, maybe it's something that it is very good or something that Ghana has been able to achieve. You, the one in school, also, you don't know what it is. So you use that term instead of saying that, oh, Ghana, we've gone for a loan, a long-term loan or long-term debt from UK, from the IMF. They would use this term. We've issued an Eurobond, right? Yes. So it's basically a long-term debt, the long-term debt. So the debentures may be a secured one. Debentures may be secured. The debentures may be a secured debenture or an unsecured debenture. Or an unsecured. So what do you mean by secured debenture? So secured debenture, as the name goes, secure. You are securing it, right? You are using the property to secure it. So it basically means that if in case the company goes into liquidation, then the debenture holders, so we are going to use the asset of the debenture holders to as a security, right? Using their assets, right, as a security for the organization in case that the organization goes into liquidation. So that is the secured word, debenture, using the asset of the debenture holders as a security in case the entity goes into liquidation. So that is the secured debenture. And I believe from this you'll be able to derive the unsecured debenture. So unsecured debenture, that is where the unsecured debenture, that one we are not going to use your asset in case the company goes into liquidation. Your asset will not be used as a collateral, right, as a security. So as a result of that, because here your asset will not be used as a security, it comes at a higher interest rate. So the unsecured debt, it comes at a higher rate, but the lenders will be charging a higher rate. Why? Because with that one, you are not going to use your asset as a security, right? Unlike the secured debt, right? Right? Unlike the secured debt, where that one you are using your assets, you are using your assets as a security, as a form of collateral. So the unsecured debenture, usually these lenders are charging or will charge a higher rate just to compensate them because you are not using your assets as a security, as a collateral, right? So that is the types of debentures that we can talk about. The debentures. All right. So with that. So their shares will fall if they do nothing. When we take an example, you would appreciate it very well. Because now, since you are not buying the shares, you are doing nothing, your share price is still there. Now, the others, those who will purchase those shares, would have their share price, the value of their shares to increase. But you guys are doing nothing, the value is there, then you are doing nothing. The value will definitely fall. Because those that are buying would increase their value. You that you are not buying the shares, you are just there. So your shares fall. I think you would appreciate it maybe when maybe we use figures. But that is it. That is it. Okay. So now let's proceed. Let's proceed. So we know that debentures can also be a redeemable debenture. So first we talked about a secure debenture, then unsecured. Debenture can also be what? Maybe a redeemable, and then irredeemable, right? A redeemable debenture. So what do you mean by redeemable debenture? Or what is a redeemable debenture? This debenture are repayable at a fixed date, right? A fixed date, or during a fixed period, in the future. So we are going to redeem this debt, right? The lenders will redeem this debt because you are going to pay this at a fixed date. You have been given particular date to pay this debt. So you are going to pay the principal. So you are going to pay the principal. You are going to pay what? The principal. So they are usually repaid at nominal value. Usually they are issued at a premium. Right? They are issued at a premium. Unlike the irredeemable debt, then they are never repaid, right? Irredeemable debentures. So for them, they are never repaid. So you'll be paying the interest throughout, right? You'll be paying the interest throughout. You'll be paying the interest throughout. Okay. So now, also, the debentures are also traded on the stock exchange, like the way we trade shares, right? But they are normally in units, right? So they can be traded. So debentures can also be traded. Can be traded on a stock exchange, right? On a stock exchange, right? But and they are normally in units. Normally in units. A unit of 100 cedis. Nominal or par value. Normally 100 cedis, unit of 100 cedis, right? Unless maybe you are told otherwise, but it is normally 100 cedis. Sometimes you can see 1,000. It's normally 100 cedis, 100 cedis. So they carry a fixed rate, right? That's the coupon. So the interest on the debentures is known as what? Interest on debentures is known as what? Coupon. Interest on debentures or loan or debt. Interest on debentures or debt is known as the what? The coupon. If you see coupon, that is the interest that you are paying on the what? The debt. How do we get the coupon? How do we get it? The coupon is the coupon rate. Is normally in percentage. Coupon rate. So percentage of the coupon or the coupon rate. Let me put it in brackets. The coupon rate. Coupon rate of the nominal value. Of the nominal value. Of the nominal value. All right. So now let us look at the advantages of the debt finance. What do you think will be some of the advantages of the debt finance over the equity finance? So the advantages of what? Of the debt finance. What are some of the advantages? One, the interest paid by the company. Usually the interest paid by the company is usually less than the dividend. Interest on the debt when you go in for loan, the interest that you are paying on the loan is usually lesser than paying your shareholders dividend. So interest paid by the company is usually what? It's usually lesser than, not less than, usually less than the dividend. Dividend paid to shareholders. Dividend paid to shareholders. Right? Yes. Usually the interest is lower than dividend. It's dividend. Dividend is always higher. Usually higher than the interest or the coupon. Okay, then we can also talk about what other advantage can we talk of? so that interest on debt, the finance cost or the interest, you are allowed to deduct it before you have to pay tax on the profit. You are allowed to deduct the finance cost when you are preparing the income statement. You see, gross profits, then you less operating costs, then you less finance costs as an operating cost, right? So you deduct this before you are charged tax on the final profit. So it's a form of advantage over the dividend. Unlike dividend, whereby the final profit is declared, then when the profit is declared, they deduct the tax. Tax is charged on the profit, as well as tax is also charged on the dividend paid to the shareholders, right? It's like double taxation. You are charging tax, you are charging the company tax as a whole, before you charge the tax on the dividend given out to the shareholders. So that is a form of tax. So the interest paid is what tax deductible or tax allowable. So you are in level 300, you've not done taxation. So when you get to 400 and you start doing taxation, you would know or understand what I'm saying. So the interest paid is tax allowable. So allowed to deduct it from your expenses so that you get a smaller profit. You get a smaller profit, and then out of this profit, you are charged the tax. But if you don't deduct it, you'll be paying a higher tax. But if you deduct it, it will make the profit small, then you are charged a smaller tax. Unlike the dividend, where they declare dividend is the profit, then on the profit they will charge the tax. When the individual shareholders also get their money, they also charge them tax, individual tax. We see the debt is much more cheaper. It's much more cheaper than the dividend or the equity. So with that, the interest paid is tax allowable to the company. And therefore the net cost to the company, and therefore the net cost to the company is reduced. So what are some of the disadvantages? With respect to the lenders, where the lenders doesn't give them the ownership, unlike equity, which gives the holder the ownership, right, or the shareholder the ownership of being part of the business. You can also see that the higher you see, as we said, that the interest rate is tax allowable. So maybe the company might try to go in for more debt or more, thinking that he is trying to cut down the tax, right? But he's trying to reduce the profit by the interest. But you see, the higher the amount of the debt finance, the higher the amount of the debt finance, the more fixed interest. You see, the more the interest you'll be paying, right? The more fixed interest you'll be paying, the more fixed interest has to be paid, right? Has to be paid out of the profit, right? So if you are using someone's profit, well, it is on this same profit that we declare or dividend. So if you are going for more debt, it means you are going to pay more fixed interest. And if you are paying more fixed interest, you are reducing the shareholders' dividend. Because it is this dividend out of the profit declared that they get their dividend. So if you go in for more interest, means you are reducing their profits, and that is not that is a disadvantage. It's a disadvantage on the part of the shareholders, right? And also the business in general, because the business will be highly geared. So that would otherwise be available to the shareholders. All right. So before we continue, let's solve the question on the. I think I posted some question the last time, which was on the right issue. The right issue. Where since you are asking me that, how would you know whether the right issue will fall? So let's take that question on that. Then we'll see whether we can. Do you have
the current share price is $5 per share. The company makes